In this video, we'll explore how to handle mortgage interest deductions when multiple people own a home. This situation raises specific questions and considerations that we'll dive into, offering clarity and practical examples. Here's what we'll cover in today's video. We'll start by introducing the mortgage interest deduction itself. Then, we'll move on to understanding ownership shares and how they're important. We'll explore some example scenarios to illustrate these points. After that, we'll discuss key considerations and tips for handling these deductions effectively. Finally, we will highlight the importance of consulting a tax professional for the best outcomes. The mortgage interest deduction allows homeowners to reduce their taxable income by the amount of interest paid on their mortgage throughout the year. When multiple people own a home together, they might wonder how this deduction can be claimed. It's vital to understand that the IRS does not base the deduction on the sheer number of names on the property deed. Instead, it's about how much each person paid toward the mortgage interest. Let's explore why ownership share is a crucial factor in this deduction. Here is a mind map that showcases the different ownership structures such as equal ownership, unequal ownership, and joint ownership with a spouse. Each type of ownership has specific implications on how the mortgage interest deduction can be claimed and reported to the IRS. You can see that equal ownership is straightforward, with deduction shared equally. Unequal ownership requires more detailed calculations to ensure each owner claims the right amount. Let's take a look at some practical examples to understand better. Imagine 3 individuals own a home equally, with each holding a 1/3 ownership and contributing equally to the mortgage interest. In this case, each individual can claim 1/3 of the total interest paid as their deduction. Now, if the ownership or contributions are unequal, each person's deduction must be calculated according to their specific percentage of ownership and actual contributions. It's essential to adjust for these differences to make sure everyone claims the correct amount. Maintaining accurate records is crucial when multiple people are involved in a mortgage. We suggest keeping detailed documentation of mortgage payments and each person's contribution towards them. A written agreement that clearly states ownership percentages can also be extremely beneficial. In case of an IRS audit, well-maintained records will substantiate your deductions. It's also wise to consult with a tax professional who can tailor advice to your specific situation. What should you base your mortgage interest deduction on when multiple people are on the deed? Is it the number of people on the deed, each person's contribution towards the interest, or an equal division of total interest? You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is each person's contribution towards the interest. The IRS bases the mortgage interest deduction on how much each individual has contributed towards the mortgage interest payment, regardless of the number of names on the property deed. For married couples filing jointly, both spouses' contributions toward the mortgage interest are combined and reported on a single tax return. However, if only one member in the marriage is on the deed and filing jointly, only the interest that the joint filer has contributed can be claimed. It's essential to account for who paid the mortgage interest accurately to ensure fair and legitimate tax filings. Don't hesitate to consult a tax professional. They can give you tailored advice, helping you accurately determine your mortgage interest deduction and ensuring compliance with IRS regulations. It's always beneficial to have expert insight tailored to your specific financial situation. To summarize, understanding your ownership shares and contributions towards interest payments is essential for accurate filing of mortgage interest deductions. Keeping accurate records tops the list of important actions, especially if you ever face a tax audit. Finally, consulting a tax professional will provide you with tailored guidance for your unique situation. Thank you for watching. If you found this video helpful, make sure to like it and subscribe for more insightful content. Feel free to share your thoughts and any questions in the comments section below. We would love to hear from you.